If you don't know, now you know. My job here is to make real estate investing as easy as possible for you, regardless of where you're starting out in your investing journey. So I say this as someone who has gone through so much of this. Like I've had to figure out so much of this on my own and figure out a lot of it on my own through books and podcasts and all that. And I guess what I mean to say is obviously I didn't figure it all out completely on my own, right? There was other resources. I had to piece together a lot of this stuff. And the reason that I've been able to go from just a handful of properties to 25 plus million dollars of real estate and just continually stacking and stacking and stacking great investments is exactly what I'm going to be breaking down for you. A big piece of my real estate success is honestly ties into my background as an engineer. For me, I think of things in terms of systems and processes, goals, what are our starting resources? If we have our goals and we're here, how do we reverse engineer the path? And then how do we maximize every single step of the process and minimize any bottlenecks? It's a lot of words. It's a lot of little corporate talk, like CEO corporate talk, whatever. But the reality of it is I get asked questions all the freaking time from people who want to buy and hold real estate, but they don't really understand what they're doing from the beginning. And I'll tell you, the number one secret to my success in real estate has been learning the fundamentals and understanding it, taking action and executing on it. But then more importantly, what helped me go from a few properties to a massive portfolio was reverse engineering the perfect investment strategy. And what I'm going to do today is break down exactly the core pillars, the four core pillars of every single real estate investment strategy, things you have to consider on every single real estate investment, lay out all the possible options for each of those four pillars, with all that good stuff included, as well as literally give you my super investor strategy, right? Like tell you exactly the strategy that I've implemented over and over and over again consistently for the last 3+ years, lay out each of the core pillars so you can choose to execute on that yourself. You can pick and choose the parts that you like. It's ultimately up to you. So I'm going to do for you today is make investing as easy as possible by breaking down these core strategies, breaking down these core pillars, which should address a lot of your questions. When you guys are asking me, should I work with wholesalers and bird dogs to find deals, or should I go to sellers and agents? Well, I'll give you my take on that. Should I focus on cash deals? Should I look for on-market properties I'll buy with, new loans, DSCR loans? Should I learn creative finance and buy creatively financed deals, right? Then people ask things that really start to kind of mix things. Should I learn the Morby method? Should I learn co-living? Should I learn BRRRR? Should I wholesale? What should I do? Well, right now we're going to focus on buy and hold real estate investing above everything else. But regardless, if you are wholesaling, bird dogging, if you are, flipping, if you are trying to be a capital partner, you're trying to be a buyer of real estate, whatever you're trying to do at the end of the day, it is so much more successful when you have an investment strategy. And even better, instead of copying someone's investment strategy, you think through what investment strategy makes the most sense for you. So we're going to start with the four core pillars of an investment strategy. What makes up an investment strategy? I want to highlight, though, that if you do not start with clarity up front, you're going to be spinning your wheels and wasting a lot of time and energy, burning out and not achieving the results that you want. That's just literally a fact. There are just too many ways to succeed in real estate. Like, that sounds great on paper. There are just too many ways to succeed in real estate. But unless you understand what does success look like for you, where are you starting out, and how are you going to bridge the gap, you're going to chase so many different things, they'll never actually get results. So although there are too many ways to succeed in real estate, aka so many shiny objects out there, the easiest way to fail in real estate, right? This really ties back into last week's training. The easiest way to fail, have no real strategy, get overwhelmed and lost, and just never make any real progress because you're either splintering your time to too many things or your investment strategy is not in alignment with what you're looking to do. So how should you choose your real estate investing path? What should your strategy look like? Well, I'm going to break all that down step by step by step, starting with the core pillars. but I'll give you a high level. For me, it's always been about the numbers. You don't achieve a portfolio like I've done in the time frame that I've been able to do it without really developing a strategy and execute on it, right? You can have the strategy, but if you're not putting in the work, it's all meaningless, right? So you have to develop the right strategy and then execute on it. For me, it's always been about the numbers. In my opinion, there's a very simple equation, which is, a very simple equation to financial freedom through real estate. It's accessibility of the investment class, right? Is it easy to learn and execute and easy to find those deals, times scalability. Can I buy enough of those properties without the typical bottlenecks people are addressing, and times the returns. So accessibility times scalability times returns of the investment equals financial freedom. The more, and honestly, it's more, now I'm getting into the weeds, it's more proportional. The more accessibility, scalability, and returns that is in line with your investment strategy, the faster the path to financial freedom through real estate investing. The faster to achieve it with higher returns, with less work, a smaller portfolio, because the whole goal isn't to work as hard as possible. The whole goal is to get the end results that you want. And for the majority of, I would assume the majority of people out there trying to buy and hold real estate, you're doing it to develop cash flow, right? Passive income that covers all your living expenses. So let me show you. I'm going to show you very clearly the investment strategies. Got a nice little slide for y'all. Perfect. The 4 pillars to, let's fix that real fast. And I'm pulling a lot of this from my Super Investors Education to provide you guys all for free. So I hope you're getting a lot of value out of it. If you are and you're here live, show me a little bit of love, please. I would really appreciate it. All right. So the 4 pillars to an investment strategy. The 4 pillars on any investment strategy, every single real estate property that you ever want to buy and be successful, every single freaking one, you have to answer these 4 questions. And even better, when you intentionally create investments and deals that are already in alignment with this, right? It's one thing to accidentally bounce around into an acquisition strategy, financing strategy, funding strategy, management strategy, right? And you end up with a deal. It's even better when you do what I do, when you start from the end goal, you create the perfect investment strategy that is in alignment with you. And then you just fill the freaking funnel with so many investments that are in alignment with your investment strategy. That is how you succeed. You literally can either randomly pick and choose random deals, random strategies, all these different things, and try to learn them all and figure it out as you go and be inconsistent and not compound the learning and the effort. Or you can do exactly what I did and exactly what I'm going to show you how to do and leverage the mathematically best investment strategy and just fill the crap out of that funnel of deals that make sense for that, and just pick and choose the ones that you want to buy that have the highest returns. So the 4 pillars to an investment strategy. You need to have an acquisition strategy. How are you going to get deals? A financing strategy. What is the main way that you're going to fund the deal, right? This is like debt, cash, all that stuff. I'll break down literally every single one of those options. We'll talk about the funding strategy. Every single deal requires money to get into. Every single deal. Even some of the absolutely perfect deals that I've structured, like perfect creative finance deals were based, I've structured deals where there literally was no funding, but you needed funding not to get into it, but to then execute your game plan for that property. And then your management strategy. You can either randomly acquire, finance, fund, and manage properties, or you can be very intentional about what you're looking for and then just execute on that over and over again. So let me briefly explain to you why this matters and why each and every one of these investment strategies, every single one of these, why it or like why each of these core pillars plays a vital role to financial freedom through real estate. Because depending on what you are looking for, right? Depending on if you're looking for cash flow or a lot of profit to fix and flip, depending on if you're looking, whatever you're looking for, it should tie back into your overall financial goals for real estate. Your pillars should be in alignment with what your financial goals are. That's why the first thing that I teach every single super investor and even provide for free in the real estate roadmap or real estate freedom roadmap free community, right? If you're not part of it and you want trainings just like this one and free tools and resources, let's get you the link for that. Because I literally have a training that breaks this down for you completely on how you could figure out your goals, your financial goals for real estate investing. So based on your financial goals, what you're looking for through real estate investing, which when I'm talking about buy and hold investing, the majority of you should be focused on financial freedom through passive income, through a portfolio, yada, yada, whatever, then your investment strategy needs to be in alignment with that. But if you're doing fix and flipping, right, and you're looking on trying to sell something for profit, or you're trying to buy a property that's distressed, right, and then renovate it, add value to it, and then refinance and hold it as long-term, the BRRRR strategy, all of these are components of your acquisition, financing, funding, like it's all tied in together. So you need to clearly understand why are you doing all this in the first place? And what we're going to talk about is buying and holding real estate for the sake of financial freedom, which very simply is your cash flow, the amount of money left over at the end of each and every month, all of it between all your properties covers all of your expenses. When all of your property cash flows, like all of the cash flow from all of your properties exceeds your expenses, you are financially free. If you want to deeper dive into any of this stuff, I've got complete trainings on cash flow, wealth benefits, all that good stuff. We're going to focus on cash flow. Like I said, cash flow, very simply, income minus expenses minus reserves, that's your leftover cash flow, right? Whatever is left over each and every month is what you could theoretically live off of. That's your passive income that you could live off of and never have to work again. AKA you're financially free when enough of that covers your expenses, your personal expenses. Well, an important metric is not just the cash flow. It's not just if you're making $100, $500, $1,000 a month in cash flow. That's one part of it. But you need to tether that to how much money it takes you to get into the investment. Whether you're doing what I do, where you raise money to fund those deals, so I'm using none of my money to buy these deals, or using your own money, regardless, you need to focus on the cash on cash return. So now you're taking the cash flow and you're saying, does the amount of money I have to invest into the deal, right, the entry cost, does that justify the amount of cash flow I make on a property? That is the cash on cash return. The whole goal is to maximize your cash on cash return. Get way more cash flow for every dollar that you invest. For every dollar that's invested as entry cost, you want more cash flow. The better that is, the higher cash on cash return, the harder your money is working for you, the better the investment, the faster you'll achieve your goals. And a big part of my blueprint, which is literally tied to maximizing cash on cash return, right? But not just cash on cash return, maximizing returns, scalability, and accessibility, is the super investor blueprint, the cheat code, whatever, right? The 3 C's, as we call it. Creative finance, so buying creatively financed deals and even generating those deals creatively, and I'll explain what that means. Using other people's money or capital raising, so creative, capital raising, and then co-living, managing those properties as co-living rentals. The combination of those 3 blows the water, like blows every other investment strategy out the water because it is highly accessible. There's a lot of deals and we're in a great opportunity to buy those deals right now because not everyone has caught on yet. Great for us, and the market will only get better for co-living investors as the economy continues to rattle and plummet. And I mean, you see it every single day right now. So the accessibility, and it's easier to learn, and there's a lot of investment opportunities, so it's very accessible. The scalability, because we're going creatively financed, we're not limited by banks and all that other stuff, And because we're raising money, we're capital raising. That also makes it scalable to buy more and more real estate. As long as we have great opportunities to buy those deals, other people will partner with us, bring their money to buy those deals. If you want to just be someone that wants to partner with me on deals, reach out to me. I'm happy to partner with you and teach you if you bring the money to these investments. And then co-living, it just rounds everything out. Once again, it's accessible, it's scalable because there's a lot of opportunities out there, and it's really high returns. All three of these feed into each of those three core pillars. But let's break down for you clearly the different acquisition, right? The different acquisition strategies, financing strategies, funding strategies, and management strategies in clear detail. So now you can pick and choose which ones you want to follow and why you would want to follow those. It's ultimately up to you. Choose your investment strategy and execute on that. If you are hoping to be a successful buy and hold real estate investor, it will be very hard to accidentally do so. The ones that drive a lot of success and scale massively are the ones who pick and choose an investment strategy that's in alignment with their goals and then just execute on that over and over and over again. You can change things over time as you learn more, but you have to start executing on something specifically. The whole goal here is to give you clarity, to remove the overwhelm, and just give you something to run with and answer a lot of your questions, because I see it all the freaking time. And I think there's a confusion because people are confusing management strategies with financing, with acquisition. Like, it's all different things. You have to answer all four of these questions for every deal that you want. So acquisition strategies. If you think of acquisition strategy, if we just make it the most simple word, or simple phrase, it's where do the deals come from, right? How are you going to acquire deals? Where do they come from? There's three core buckets: direct acquisitions. You can directly work with agents or find properties on market, right? So properties on the MLS, or work directly with agents, or work directly with sellers. You can joint venture with people, which means you joint venture, or like you build a relationship with someone, or you help get a deal to the finish line. That's similar with referrals. So direct acquisitions with an agent is you find a property on the market and you reach out to that agent specifically for that deal. A referral-based or repeat agent relationship in this middle tier is you reach out to them potentially for this one deal, but if you're smart and you do what I've always done, you say, hey, this deal may or may not work, but I want to be your go-to person if XYZ situations arise in the future. If you have properties where the seller does not have equity and they would have to sell it and pay money to sell it, or they can't adjust the price anymore, or they have a lot of equity and want to avoid taxes, or the property is super bad condition, or whatever, right? It's not just talking to an agent about the individual deal, but developing that relationship for repeat investment opportunities. Similar with helping newer investors, because if someone's a fully operational wholesaler, they don't really need your help. But if someone is starting out, just figuring things out, even bird dogs could be included in here. You're helping them because they might find the motivated seller, but they don't know how to structure a deal, or they don't know how they're going to close the loop and get it done. So that's in the middle tier. And then you can also just buy deals under contract. You can buy deals from wholesalers, right? People who have already found the deals, structure them, and you're just paying them a fee to take over that contract. Or bird dogs who are looking at these investments that wholesalers typically have under contract and then aligning it with the buyer's ideal criteria of what they're looking for. So the wholesaler is starting with the seller, where the bird dog is typically starting with the buyer. The bird dog is saying, hey, buyer, let's get clear on what you want to buy, where you want to buy it, how you want to buy it. And let me go look at all the deals out there and see if I can bring you 10 of them that make sense that you want to move forward with. Where the wholesalers are structuring deals with sellers and then sharing them with the buyers on their list, right? Just they're starting from different viewpoints, but the whole goal is to get seller deals bought by buyers, just a few other middlemen in there. The difference is, for your acquisition strategy, you have to determine where do you want to go here? And it's going to depend on your skills, your time availability, like how good are you to be able to do direct acquisitions is going to require more skills, more effort. I think I phrased this wrong, but I think it's right. More skills, more effort, but you tend to get better deals because you're directly working with the seller or agent directly. So that means you're paying less in fees than you would with these guys, but they're the one doing a lot of the work on your behalf. As you go down, it's easier and easier in regards to the effort. The effort is massively different to get a deal to buy, but the deals are worse and worse because there are typically more fees involved in that. It's really where you want to use your time and energy. Like I said, I'm laying it out for you to decide. Are you going to do direct acquisitions? If so, how? Are you going to joint venture or work on referrals? Are you going to buy deals under contract? You decide that for you. I will recap the super investor strategy at the end, but you decide that for you. What makes the most sense for you? Are you willing to put in more effort and develop more skills to get better deals? Or are you know what? I think I understand how this could work. This would just be the same thing. Boom. I've always wondered, always looked off to me, and I didn't understand why. And more effort, better deals, right? At the top. Less effort, in theory, worse deals. Because if it's the same deal that you could have bought directly, then that you're buying from a wholesaler or bird dog, you're just adding additional fees on top of that. All right, those are your core acquisition strategies. You have to choose how are you going to find deals? Where are the deals going to come from? Next is your core financing strategies. We're going to go into these in brief detail. I'm not going to go too crazy on any of these, but this is if you have a deal, how are you going to finance that? How are you going to basically buy that investment, right? We're not talking about down payments and all that. We're talking about how will you actually buy that investment? Are you going to buy it using cash? Are you going to use a traditional loan where you're going to use an owner-occupied loan? You live in the house and then you rent it out when you move out, or you live in a room and you rent out the rooms, or you live in a unit and you rent out the other units, right? House hacking, owner-occupied loans, other forms of conventional real estate loans, commercial loans, construction loans. So DSCR loans, which is just like straight up investment loans, BRRRR, which is a combination of distressed cash deals, buying with hard money, improving the value, doing a refinance into a long-term, typically DSCR loan, and now you own it as a rental, or the subcomponents of creative financing. So there's the acquisition you have to decide, but then there's the financing strategy. I'll briefly go through all this, but you can look at this later if you choose to. And if I start getting some love in these comments and in the community, and we get a bunch of people to go there, I will share some of this stuff with you guys into our cheat sheet, the Super Investor Investment Strategy cheat sheet. I will share that with you guys, but I got to see some interaction. Otherwise, show me that love so I understand that this is what you guys need. All right. So like I said, cash deals, are you just buying it cash? Owner-occupied loans, conventional loans, commercial loans. Typically, it's like a conventional loan, but it's for properties that are 5 units or more, or you might need to do that. You might need to use commercial loans if you've already got too many conventional loans going on. That's why traditional financing is not very scalable. At a certain point, it's hard to keep getting loan after loan after loan the traditional way. You can use DSCR loans to overcome that, or you can use creative financing to completely mitigate that because it's not tethered to you in particular. It's not tethered to your credit in particular. Construction loans, so these are short-term loans where you have the land, you develop a property, or you do some major renovations. Well, yeah, you can construction/development loans, right? You can either do a major renovation or build a new property and then refinance it into longer-term debt. The BRRRR strategy, where you're going to buy, renovate, rent out the property. So you're going to buy a property, typically cash because it's in some distressed condition. You're buying it cheaper. You're going to renovate it, get it to its peak value. You're going to rent it out, fill it with a tenant, and then you're going to refinance, put a new debt in place, and that money is going to pay back all the existing money and maybe even make some at the end of it. Or sometimes BRRRRs are not perfect and you actually have to put money in to refinance, but you have some of your money back, if not all of it, and you get to repeat that process over and over and over again. Or are you going to leverage creative finance or creative plus traditional combos, right? Creative finance falls into 3 core buckets. There's more, but 3 core buckets, which are subject to, I'm going to buy a property with the existing loan in place. So I'm going to buy the property and be the owner, but the seller's existing debt stays They're still in theory responsible for that. I'm just the one making payments for it, and I own the house now. That is subject to. I'm buying the property subject to its existing loan. Seller financing is kind of like a new loan, but instead of a bank, the seller is the bank now. So instead of getting a new loan from a bank to buy the property, the seller acts like a bank. You pay them the down payment, you pay them the monthly payments, you guys agree on all the terms. It's great because you can pick and choose exactly how you guys structure that deal. There's no like forced requirements like a bank will have. Or hybrid, which is also very common. It's a component of you're taking some of the loan subject to, or some of the purchase price is subject to, some of it is seller financed, right? So for example, you're buying a $400,000 property, you're putting $50,000 down payment, you have a $300,000 loan in place that you're taking over subject to, and that last $50,000 of equity, right? 400 minus 300 minus 50, that last $50,000 left over is seller financed. I'm actually going to show you guys real quickly on the calculator how you can see this stuff so you can understand it. You guys can always grab the free copy of this calculator. Let me see. I'll drop it to my Instagram friends too, because I always forget to share it with you guys. And all these free tools and resources are also in the Real Estate Freedom Roadmap community. Like literally, it's all here. You can grab anytime. If you're watching this as a recording, I'll just show you how you can do it so you can grab that. Literally, you join the Real Estate Freedom Roadmap absolutely for free. You go to the classroom. There's a bunch of free courses, tools, and resources for the Co-Living Freedom community. You have to pay to be part of that. You don't have to be part of that. So if you want to get way next level when it comes to co-living investing, you want the step-by-step roadmap, it's all there with all the tools and resources. But you can go to Real Estate Investing Analysis. Pretty much any one of these will have the calculator, and it's grab your free copy of the calculator, right? If you don't know where to get it, grab your free copy right here. Just click it. It'll look like this. Put in your email, put in your name, boom, calculator sent to you. You get to get a new fresh copy every single time. So now that we've grabbed the calculator, and this is why my calculator is so impressive and why people love it so much, is because you can do all those acquisition strategies here. You can do cash by clicking a button. It'll automatically adjust things, right? Just cash. You're buying it and the full down payment, right? The amount you're putting down is literally the full purchase price. You can do traditional, where typically it's a 25% down payment. You can adjust that, right? If it's 30, if it's 50, if it's 10, whatever. You can do a straight subject to deal, where you're buying the property subject to its existing loan and you're paying out all the equity the seller has, or straight seller finance, where you're giving them some down payment, if any at all, and the rest of the seller finance based on the terms you guys agree on. Or hybrid creative, where it's a combination. You buy the property, right, for $400,000. You give them $40,000 up front. You're taking over the $321,000 loan. That means the remainder is seller financed. 400 minus 40 minus 321. The remainder is seller financed at the terms that you said. And here's how you would analyze that. This is why the calculator is so freaking powerful. It also includes Morby method, but I don't want to get too far into the weeds. Hopefully that visualization provided some extra value, like putting it in there for you. And then creative and traditional combo, typically that's the Morby method. So typically you're going to take out, in this context, you're going to take out a whole new loan to buy the property. And instead of the seller receiving all of the profits, they're going to give you some of it back and then seller finance it to you. It's a strategy that lets you buy a property and put less money into a deal. So I get asked all the time, should I focus on Morby method? Should I focus on Morby methods? Yes. It just depends on what you mean. Is that going to be one of the buckets for you as an acquisition strategy? Potentially. Because I'll be transparent with you. For me, where I'm at right now in my investing journey, I do Morby methods. I do all forms of creative finance. Creative finance straight up deals are my number one favorite. My second favorite are creative plus traditional. So Morby methods or variations of that. We have some other variations of that are even cooler, but they'd be more complicated to explain. I like BRRRR deals on occasion, but they're really subject to finding really distressed properties that I buy cash that are being massively renovated, and then I have to put in long-term debt. And when interest rates are 7, 8%, and I require to put 25, 30% down payment, it starts becoming less and less enticing. I can just get better deals going this route. I do buy properties straight up with a DSCR loan sometimes. Literally the whole foundation of my real estate investing journey, my first several properties were through owner-occupied loans, house hacking. So the goal, especially to be a super investor, is you want to have all the tools in your tool belt, but prioritize the financing strategies that make the most sense for your overall investing goals. And like I said, I will give you that in more clear detail, if you didn't catch it earlier, on the types of deals that I love to buy and why. The exact, like which of the 4 pillars I'm doing on all the deals that we're looking at. So you have to select which ones of these make sense for you. I'll give you a very simple way to consider, at least between cash style purchases, so like a cash and a BRRRR deal, primarily cash and BRRRR deals, versus buying something that you're just buying as a rental from the very beginning, right? Like, you know, it's going to be a rental from the very beginning, versus you're going to buy something that's cash, add value, and then pull your money out through a refinance or sell it for profit, like a fix and flip. So cash deals, really, is the property really distressed? Like, you're buying it at a massive discount. If you're buying a property at a massive discount, typically it's going to be a cash deal that you fix and flip so you can profit from that, get that equity up front, or do a BRRRR deal so you can buy the property and pull all of your money out, right? That's kind of the idea there. If it's a distressed property that you're able to buy at a discount, typically you're buying it cash and you are either capitalizing on the equity by selling it for a profit, a fix and flip, or you're capitalizing on that by doing a refinance, leaving some of the equity in the deal, right? Because you have to leave 25% equity in the deal, but now you have a property with all your money back out. In theory, this sounds perfect. The reality of it is it's like 6 steps at once. You're doing finding great deals, you're fixing and flipping, you're assuming the rent income, you're assuming that, like, they're doing a lot of things where people can make things go wrong with a BRRRR. In theory, they work well. The more and more expensive properties you're buying, the more and more risky it is. And the debt that it costs to acquire and renovate these properties can totally crush you very quickly. It's the same reason why we're helping someone else right now who got into a very bad BRRRR deal and needs to get out as soon as possible because they cannot do the refinance. I'm telling you right now, that is way more common than you can anticipate. The problem is you only hear of all the good BRRRR deals, right? Survivorship bias, not all the people who get completely taken out by these not working. Same with fix and flips, quite honestly. People have earned and saved and made, hundreds of thousands, whatever, built a portfolio, and then lose hundreds of thousands or millions because they cannot sell a property, and their hard money loan, the hard money loan they used to buy it, completely is about to explode and just deteriorate everything for them. So they just have to get out. And when you're buying something, especially like if it's turnkey or rent ready to go, creative financing, I guess traditional financing, right? If you don't have creative deal flow and you don't know how to set up creative terms, if you're buying something that's more turnkey, right, ready to go, traditional loans, creative financing for sure, or the combo of creative plus traditional, right? This is those that do have equity and want some of it, but don't need all of it, or they want a higher purchase price. There's usually a couple of variations for why this makes sense. But this is a core part of my investing strategy because I'm focused on buy and holding investing. The reason for that literally all ties back into cash on cash return. For the most part, I'm going to be able to buy properties with better debt, lower interest rates, going creatively than traditionally. So for me, going creative means I get more cash flow. On top of that, my entry cost, one of the biggest parts of an entry cost to get into a deal is the down payment. Once again, creative typically has a much lower entry cost, lower down payment than if you were doing a traditional loan where you need 25% down payment, or a cash deal where you're putting 100% of the purchase price up front. Typically, the more you put towards the debt, right? If it's a $400,000 property, very simply, If it's a $400,000 property, let me make a copy. So demo, so I don't mess with the version for everyone else. And I hope this is intuitive and this is obvious to you, but it may not be. If you're buying a property for $400,000, no matter what, the more you put down, the lower the debt amount. Okay, so we're buying a property cash, we're putting $400,000 down, there is no debt. You're paying the whole thing up front. If it's traditional and you're putting 25% down or $100,000 down, well, the loan is $300,000, right? You're probably going to be at a higher interest rate as well, but it's a lower down payment. If you're doing, let's say, seller financing with a 10% down payment, so instead of $100,000 down, it's $40,000 down, your loan is higher. Instead of being $300,000, $360,000, because you're putting less money down. Well, the question is, not only are you putting less money down, which is great in regards to lowering entry costs, but how does this affect your cash flow? Well, if your loan amount is higher, typically your loan payments will be higher unless your interest rate is substantially lower. So in this example, it was 17.77 for a $360,000 loan, right? $360,000 loan amount, right, with 40% down or 40,000 down is a $1,517 monthly payment on the seller finance loan at the 3% interest rate, right? It's at 3%. All right. So even if we go to traditional and you're putting $100,000 down, your loan is $60,000 less right here, because it's at a higher interest rate, even though your loan is $60,000 less because you put in $60,000 more upfront, your monthly payment is actually over $500 more every month because of this interest rate. So you're putting more money down, and so your loan is less in theory, but the payment on your loan is substantially higher because of the higher interest rate and seller financing. If that didn't briefly and quickly and efficiently summarize for you why I almost always am buying properties creatively over traditionally when we're in a high interest rate environment, I hope that visualization did it for you, because I can say it all over and over again. Some people need to see it. I hope that clearly showed you why I almost always buy creatively. The caveat with, let's say, a Morby method where you're combining a whole new loan, even though it's at a higher interest rate, a whole new loan, but with the seller financing component, is instead of that $40,000 I would have put down, even though I have a much higher payment here, this $2,097, I'm actually putting no money down because the seller is financing the rest. Sometimes you can get this at crazy good terms. You can get it at 0% or no payments or whatever. So it's really a trade-off when you're calculating your numbers. Does it make sense to put little to no money down, if possible, if the deal allows for it, even if it comes at the cost of higher monthly payments? That's the question. That's the full analysis needs to get done for that. I can't answer that for you because the full analysis needs to get done. You don't know how it impacts things. I mean, I can tell you right now that instead of $40,000 down, is the $40,000 less upfront justify an extra $580 a monthly guaranteed payment and maybe another $400 of seller finance if that is the terms of the seller financing. So it's almost $1,000 more. Does the $40,000 lower down payment justify paying $1,000 more a month, right? And that is quite literally what deal analysis is all about. That's why this calculator is literally all of it, right? The debt information, the acquisition information, how that ties into your entry cost, your total entry cost, because that's not just the only entry cost is down payment. That's one of the many pieces of an entry cost. You still have tax and insurance, which should not change on your property. Then you have the management information, right? It could be that the deal does or does not make sense as a Morby method. You won't really know unless you do the deal, because it could be that, yes, you're putting less money down, so maybe your cash on cash return could be higher or not. In theory, lower entry costs, it could be higher. You're also losing more in cash flow, you have to calculate that and see if it makes sense. Well, a big part of it, and we're going to get to that coming up, are the management strategies. That's the final piece. People confuse acquisitions, the financing, creative, the Morby, the whatever, with the management strategy. Well, that's totally different. They're different parts of the same, I guess, they're different components of your investment strategy. They're necessary, but they're just different. They play a role into each other, right? Like I said, if you're acquiring creatively, you're more likely buying it as a long-term hold. It doesn't matter if you're buying it as a long-term rental, co-living rental, midterm, whatever, right? But if you're buying something cash, you're probably doing a fix and flip. So they tie into each other. What will you do with the property is dependent on the way you also acquire it. But to know the exact way to do it, it really depends on a couple factors. You have to analyze the deal. I can tell you, just looking at this very simple example without adjusting anything, we saw that if we were to buy this property and manage it as a co-living rental, that's going to be 8 bedrooms total, whatever, as a Morby method. Is that what this is? As a Morby method, where you're putting no money down, all of it's getting seller financed, the new debt. It's coming at increased monthly payments and all that by $1,000, but you're putting $40,000 less entry cost. Your cash flow is $763 a month, and your cash on cash return is 11.6%. So I'm gonna do is I put that here, Morby, and let's see if this was just a seller finance, what that would look like. So it's doing its whole thing. Everything's automatically done in this scenario, just putting in preset values here, right? You adjust them based on your actual deal. Well, even though you're putting $40,000 more, you are getting almost $1,000 more in cash flow. Is that worth it or not? I can tell you this is almost guaranteed to be way better. Like 99% certainty, but that's because I do this so much. So yes, even though you're putting $40,000 more entry cost, the extra $1,000 of cash flow has a way bigger impact than the $40,000 additional entry cost. So now seller finance is better. It's like you wanted to do Morby, but maybe you could have just tried seller financing and figuring out, can you pay the down payment or whatever, right? It really depends on how much equity they were going to have. All right. The next piece is let's do this. If this was, we can't do sub 2 because it's just all made up. We can do hybrid as another example. So if there was a loan in place and you're able to lower your entry potentially, or let's do traditional. That's a perfect one to do. Traditional, right? I mean, this is going to be worse because we already know it's going to be worse. You're paying more monthly. You're paying a larger down payment. You can visually see, yes, the cash flow went up because your debt is lower. So it went up compared to the, this was the Morby, because it's just because you, instead of the seller financing, you're just paying the cash flow there. But your cash on cash return is actually lower because you're putting more money down. So it's better. Traditional is better cash flow, but lower cash on cash return. That's why it's not easy to say, oh, do this exact strategy. You have to analyze the deal and see which one makes the most sense. But none of that matters if it doesn't work for the seller or solve their problem, right? That's a whole other multi-hour video that we could do. And it's part of the stuff I gave you guys in the Real Estate Freedom Roadmap community. All right. So for me as a buy and hold investor, my goal is how can I maximize my cash flow and lower my entry cost? I'm trying to maximize my cash flow by buying properties with better interest rates and all that, not necessarily by paying down the debt substantially so that my debt payment in theory is lower, because we just saw you could do that with a cash deal. You could do that with a traditional loan and pay a larger down payment, have a lower loan amount. And in theory, your loan amount is lower, so your monthly payment is lower, but interest rates play a huge role in that. And it really messes up your cash on cash return because your entry costs are substantially higher. So to think of what I think when I'm buying my deals is how can I buy properties for the least amount of down with the least monthly payment on that debt? Like I'm always trying to think, how can I pay the least amount every single month on the debt, right? Lower interest rates and all that stuff, and put the least amount of money down. So the third pillar of your investment strategy is funding. How will you fund the deal? There are 3 key components to funding the deal. I will show you that. But understand they fall into three categories. They fall into the acquisitions, the cost it requires to buy the property, right? What does it cost you to buy the investment, right? What are your agent commissions, wholesale payments, down payments, closing costs, all that kind of stuff? What does it cost to buy it? And I'll visually show you where that's at. What does it cost to renovate the property, right? Convert it into the property that it needs to be rent ready for you, right? So I call this your rent ready cost. So to renovate it, if you're going to furnish it, the furnishing cost, any carrying costs, if you're paying the mortgage and utilities while you're renovating and furnishing the property, well, that's part of your rent ready cost. And then any additional reserves you're going to set aside for the property. This is important when you're raising money. If you're using your own money, you don't really need to account for reserves. Just make sure you have the money, but it doesn't need to be part of your calculations. When I am raising the money, it has to be a consideration because I need that money in reserves set aside for the property as well. On the calculator, it's very simple. The down payment pulls into the down payment here in the entry cost. Then the other acquisition costs include, like you're buying a property that's in pre-foreclosure or the seller's missed payments or there's liens, you have to pay off those liens. That's part of your acquisition. If there's an agent involved, you have to pay them. That's part of your acquisition cost. Closing costs, you have to pay that. If you're paying a transaction coordinator, you're forming an LLC, you're doing an inspection, that's all part of your acquisition. If you're paying a wholesaler an assignment, or if you're paying yourself an acquisition fee, these are all part of your acquisition costs. This section are all acquisition costs. Well, then we have your rehab and furnishing costs, right? And I have this in two buckets. One bucket is what would it cost me to renovate the property to just get it rent ready as a long-term rental? That's what this one is. But for each and every management strategy, it's going to depend on your management strategy, how much you're going to renovate and furnish and what that's going to cost. It's a long-term rental. You've already accounted for that rehab right here. So you don't need to add that anywhere else. If it's co-living, well, I'm going to have to build out the rooms and I'll have to furnish the property. But if it's a midterm rental, I'm probably not adding any rooms, but I might do some renovations. And the furnishings are probably going to be on par, if not better, for a midterm rental than a co-living rent by the room property. Even further, with a short-term rental, you're probably going to like paint murals and your furnishing costs are going to be more. You're going to set up a game. Oh, I'm not even showing that. There we go. Let me go through that again. So your entry cost, if it's very simple if you consider it this way. There is the first acquisition cost, right? The three buckets: acquisitions, renovations or rent ready, right? And furnishing, and your reserves. Like I bucket that all right here into these three, right? I have my total entry cost, a third, like some of it's acquisition, some of it's rehab and furnishing, some of it's reserves. So to see how that's broken down to the calculator into its own categories, the first acquisition cost is your down payment, which gets automatically pulled into here. Okay, so your acquisition cost is made up of your down payment, right? How much money you have to pay for the loan to the seller, whatever. Are there any arrears or liens you have to pay off to buy the property? That's part of the acquisition cost. Any agent commissions, the closing costs, any administrative costs, like if you're paying a transaction coordinator, you're forming an LLC, you're doing an inspection. If you're paying a wholesaler an assignment fee, if you're getting paid an acquisition fee, right? You wouldn't do that to yourself, but if you're raising money and you're accounting for that, those are all part of your acquisition costs. This is that first bucket, your acquisition costs. That needs to be accounted for. Even the perfect BRRRR may not cover all this alone. Well, the second phase is the rent ready / rehab furnishing costs. I have the rent ready costs and the rehab bucket into two areas. One, to get the property renovated to be a good long-term rental. That's this one right here, right? But for each different management strategy, there are different rent ready costs because you're going to do different levels of renovations and furnishing depending on the management strategy. For a long-term rental, you're more than likely, well, you're not furnishing it and you're getting it rent ready. You don't need to go crazy more often than not to renovate it. And if you do, you're probably going to do that as the minimum standard for everything else first and foremost. If you have to replace the roof, if you have to replace carpet, whatever, that's all here. But based on the management strategy, it's going to depend the level of renovations and furnishings that you do. Doing a co-living property, I'm typically buying a property and then adding more bedrooms from some of the common areas, turning offices and living rooms and dining rooms and whatever into additional bedrooms. Well, part of my rent ready cost for co-living is that cost to convert those rooms into bedrooms, plus the furnishing costs. But if I'm doing a midterm rental, I might be doing a lot less renovations. So midterm rentals might be doing a lot less renovations, but typically I'm furnishing it the same, if not better, for a midterm rental because you're fully furnishing the house. Whereas a lot of times in co-living or rent by the room, you are 75% furnishing the bedroom, right? You're not going above and beyond with decor and all that. You want to give people who are staying there longer the ability to decorate their room and make it ideal for themselves. Well, if it's a short-term rental, you're probably doing more renovations. You're probably adding murals and all these other things, especially if it's a high-level short-term rental, and your furnishings are going to cost you more typically than a midterm rental or co-living rental because you're going to maybe do a game room. You're going to do all these extra things. You're going to buy the leather couch versus you're going to pay more for that kind of stuff. So it's important to understand those costs. And the only other component there are any carrying costs and or reserves, right? The cost to cover the utilities, the mortgage, and all that other stuff, your insurance during the renovation rent ready phase, and then any upfront reserves you want to start the property out with. So you ultimately have three options to fund your acquisition, rent ready, and reserves for a property. You can either use all your own money, right? If it's $110,000, $50,000, whatever, use all your own money. You can use other people's money. So you're raising the money from a private money lender, a private money partner. You can use transactional funding if you're going to go the BRRRR route and whatever. It's not going to cover everything, but some of it. Or you do a combination of using your own money and other people's money together, right? You can use other people's money to fund 50,000, you fund the rest, whatever, but you have to consider how will you be funding these properties? Do you have the money to fund a property based on your investment strategy? The cheapest, lowest cost to buy a property is always a long-term rental. Just assuming it's the same acquisition strategy, it is always a long-term rental because you're going to pay the same amount you would for any other strategy here, but you're not adding any additional renovation or furnishing costs for a long-term rental. So the cheapest in this scenario is $141,000 for co-living, $177, midterm $161, and short-term rental $171. All these numbers are basically they're just templated numbers. They're not exact for an actual property. They're just numbers that are here as placeholders. A big way to reduce your entry cost, a big part of my whole strategy is reducing my entry cost by, instead of going traditional, going creative. For example, let's go hybrid creative, so that now my minimum entry cost to buy the property is $80,000 as a long-term rental. Well, then we add these costs. Now it's $115,000 as co-living, whatever, and just keeps moving on. But the idea is, this is why I focus so much on creatively financed deals instead of always putting a 25% down payment, paying higher closing costs. You have to pay lender costs and all that other stuff. Even if I'm paying a wholesaler money to buy that deal, if it's creative and it makes sense for me, it's almost always cheaper than going the traditional route. Almost always. And the terms are even better. So not only am I putting less money, I'm also getting higher cash flow than I would have as a traditional investment. So this is why it's very important to understand and have things in alignment with your overall goal, leading and starting with how you acquire deals, right? And you can figure that piece out last. For the most part, what's your overall goal? And then determining, in my opinion, how do you want to manage it, right? Like what kind of management strategy, which is the next one, which is right here. We'll get into it, which is the next one. How do you want to manage the property? Because then you have to choose where you want to buy these properties and how much are they roughly going to cost you and all that stuff. And then choosing. So if I were to show you, I think it works best. And this is what I did. My management strategy and my financing strategy were the things I focused on. And I already knew my funding strategy was going to be raise money from other investors. I knew that was going to be my funding strategy from the beginning because I knew I wanted to build a very huge portfolio. And there was just no way in a reasonable time frame, I could earn and save enough money to build the portfolio that I wanted to. There's no way to have built my $25+ million portfolio. I could have earned and saved $6+ million to fund these acquisitions, renovations, like rent ready costs and reserves. There's no way I could have earned and saved that unless I made a bunch of money, saved all of it, and was willing to allow it to stretch 40+ years. Well, the goal was in less than 5. So I knew I needed, and honestly, for me, it was the funding, I guess, the capital raising. It's all kind of one and the same, I guess. So funding was a big part for me because I knew that's why I needed to be scalable. Financing was a big part to make the deals better, maximize returns, maximize scalability, make things more accessible, and same with the management. And the acquisition was what is the highest and best use of my time? And that is the super investor blueprint, cheat code, investment strategy, whatever, the 3 core C's, which I'll recap for you guys, including, and it includes all 4 of these, but these 2 are combined in one in the way I talk about it. All right. So your management strategies, like the final pillar you have to decide. We're assuming you're buying properties as rentals. If you're going to flip it and all that, obviously you can flip a property. It's not a management strategy. You're buying it, renovating it, selling it for a profit. You can do different asset classes. We didn't even get into that. We're only assuming single family homes or small multifamily homes here as an asset class, because then we can get into different assets, large multifamily, small multifamily, like the 5 to 50 unit space, commercial, industrial, all that other crap. We're talking about buying homes and renting them out for these management strategies. You can either rent it out long-term, unfurnished, long-term rental, typically 6 months or longer, unfurnished property, which is good for more stable, predictable income, but there's just a lot lower cash flow and a lot harder to find deals that make sense that way. Midterm rentals, which is a furnished rental. So you're going to furnish the property and typically rent it out for 30 days to 6 months at a time. That is good because you can get higher rents typically than a long-term rental, but there is a decent amount of management. It's less than short-term rental and co-living, but there are downsides to it because that's a more limited buyer pool, and you have to understand it's also lower income. There could be big vacancies between them. It just really depends. Short-term rental, where you're buying a property and your average stay, you're buying a property and renovating, furnishing it. Your average stay is typically 30 days or less. Typically 7 days or less is really what it is. But let's say 30 days or less, often daily or weekly stays. You have the potential for a lot of income, but it also requires a lot of management operations. Income will fluctuate a lot seasonally, and it can be heavily regulated in many cities. And if it isn't currently, it might be in the future. If you're thinking your market is not that. And then co-living, rent by the room, which is my favorite strategy, not only because of the maximized returns on the stability of the income, but also because it's operationally easier to scale because you can develop systems better than every high-end short-term rental. It's a lot easier to develop co-living systems that are scalable and find the resources for that, but also the opportunities and the deals and the trajectory of this asset, this management strategy is massive. It's 1/10 the size of short-term rentals, and it has every economic indicator showing it's going to grow massively, not only because it has been, but because, and it's becoming more accessible, but because literally the economy needs it, because there's literally no middle ground for people who cannot afford a 1-bedroom and have to live in their car. There is very little middle ground for them, right? Live in the streets, live in your car, or don't afford a 1-bedroom. This is the middle ground for people. So, as a very brief recap, your investment strategy, you decide whatever you want in your investment strategy. It's a lot better when you have clearly defined the 4 pillars and you're working every effort in alignment to say, I'm doing co-living deals. I'm going to raise money for these deals. So it doesn't really matter for others. Like, it doesn't matter that you share that, but you need to understand, I'm going to raise money for these deals. So I need to start raising money, or I'm going to use my own money. So I need to start earning and saving the money. Like, it's part of your overall strategy. What types of deals you want coming your way? Are they creative? Are they cash? Are they ones with lots of equity where the potential for traditional plus create? Like, it's ultimately up to you. And then how are you going to get those deals to come your way? And then what information are you going to be sharing? And what types of deals are you looking for that work well for all of this? That's ultimately up to you. As promised, I'm giving you a very simplified breakdown. Well, it's not even simplified, very detailed breakdown of the super investor strategy that you can either copy, use yourself. I don't care. It's ultimately up to you. For those of you that want help implementing all the core systems that are required to actually execute on this on a high level, to actually get deals consistently this way, to analyze them effectively, to understand financing, to develop your capital raising skills so you can fund them using other people's money, and to get the step-by-step education and resources and tools and support for co-living, that is what my Super Investors Mastermind community is for. Imagine this on steroids, and you get every single system, tool, and resource to help maximize each and every one of these levels, each and every one of these pillars, which focuses on deals, money, and operations. That's what all this buckets into. But your investment strategy is the starting place for all of this. It's the clarity for all of this. So, acquisition strategies. I prefer to buy deals that are already under contract. So either they're coming from wholesalers or bird dogs. I am more than willing and happy to pay wholesalers and bird dogs for doing a lot of the initial filtering of sellers and agents to find me investment opportunities. I will then further analyze and see if I can buy it as is or improve those deals. I'm also open to working with people who want to joint venture. They found a motivated seller but don't know how to structure it, or developing referrals or repeat newer investors and agents that I can work with over and over again. That's my ideal. People that I can help educate and train, and we're doing this over and over and over again. But honestly, most of my time and energy is finding deals that are already under contract, analyzing them, and buying them. That's the majority of what I do. Bird dogs help that process out as well, because we can't see everything. They might see something that we wouldn't have ourselves. Financing strategies. I literally am almost always buying properties creatively, seller finance, subject to, or hybrid. Like, it's typically one of these three. Sometimes I will do creative and traditional if it makes sense, the combo of those two. If it means I get into a deal with little to no money out of pocket, I've got like 50 examples of this, or like 10 that we've done that I can really break down why we chose to go that route. But usually it's because I'm buying it with little to no money out of pocket. It's how I bought my 20 rental cabins, the first literally no money out of pocket deal I've ever done, first creative deal I've ever done, the first investment that wasn't a house hack. I've got plenty of videos on that. I'll buy properties with new debt, a new DSCR loan, or sometimes I'll even BRRRR, but it really depends. These two I'm typically only doing when interest rates are better, or if the deal is a screaming good deal and this is the only way to get them because it's either distressed or they want me to buy the property and they want their money, and that's the only way to do it. If it makes sense, we will do it that way. But more often than not, almost exclusively, it's creatively financed deals. And then each of these, it basically progresses. If I'm not doing one of these, this is mostly a little bit of this, even less of this, especially right now. A whole part of being a super investor is not copying and pasting what someone else is doing all the time. It's learning and understanding when is the best time to do this stuff. When interest rates were low, I was buying traditionally, and you should have as well. There is no always perfect scenario. Like, there is none of those, because when you have to understand what is the perfect scenario based on the current economic conditions, and then understand the different ways to make the most of that. If I stuck to one strategy, I would not have achieved what I've been able to achieve in the time frame that I've done so. A big part of it is understanding the various acquisition and financing strategies. I fund all these deals using other people's money. I bring great investments. Capital partners fund those deals. We co-own them, and I operate them successfully for us. If you are someone that is interested in seeing the types of deals that we're doing and you want to be a partner on those deals, I just dropped the form in there where you're more than welcome to express your interest in what kind of deals you're looking for. And we can maybe partner on those deals. If you want to be the money partner, we'll find the deals. We analyze them, right? We choose the ones we're going to buy. We present it. We own them together, and we operate all of it ourselves. I'm also open to a combination of using your own money and other people's money. I will say that I have not used a single dollar of my own money, and pretty much the majority of my investing journey. The only time I've really done it was my second house hack. Well, my first house hack, but it was it's like less than $13,000. The second one used a HELOC for my first one, whatever. Everything has been creative since then. And I've raised the money for them all. But I would be open to using my own money and raising money on deals because it increases the returns for both. But for me, because I'm so good at finding such great investments and operating them so successfully, there's no shortage of capital partners that want to do deals together. So there is no reason for me to use my own money, but it is a viable strategy if you need to, especially to juice the returns for everyone, by putting in some of your own money as well. And the management strategy for me is almost exclusive co-living. Like it's almost all I've done over the last 3 years, over and over and over again, because of the returns, the scalability, the accessibility of those deals. It is the foundational bedrock of all of this stuff for me, head and shoulders. That is literally why I got very upset at the fact that, at the fact that people charge so much for co-living education out there, right? I thought it was ridiculous because I don't think they provide a lot of value. They don't provide a lot of support. I don't think they educate nearly as well as I do. So instead of charging $5,000, $10,000, whatever, and most people are charging, some people charge $50,000 to learn co-living. Instead, I offer it in the Real Estate Freedom Roadmap community. You could literally go in, and this is what it would look like for you. If you're not part of it, you can click it and unlock this training or this whole community for $197 a month. You unlock it, you join it for $197 a month, cancel anytime that you desire. I don't care. You cancel. You get everything unlocked immediately. Every training, every tool, every resource, every single thing immediate unlocked. No, nothing hidden, nothing, whatever. It's all there for you, whether you stay for a month, 6 months, or whatever. And it's the same reason why I'm going to be doing a 3-day live co-living challenge in sometime in the next few weeks, that you are more than welcome to take part in, because I want to make co-living as accessible as possible, whether you're a bird dog, a wholesaler, a cat partner, or a buyer, you're just starting out, whatever. I want you to understand how imperative it is that you leverage co-living as one of your core management strategies, especially right now, because it unlocks every single thing else. You get way better returns. There's way more deals out there. It is literally the fundamental part of this entire super investor strategy. I also will do sober living and assisted living homes and things like that, but I'm never the one managing those. Our businesses, like even our business, we're just renting them out to nonprofits and things like that, or others who will operate them as those strategies. But it's just a subsection of co-living. It's no different than co-living. It's just a more niche case of co-living. So it's rent by the room, but we're just renting it to someone else who's renting it by the room typically. All right. So I gave it all to you guys. I need you to like leverage this stuff and understand, once again, you will struggle with any and all forms of real estate investing, especially acquiring real estate investments if you want to be a buyer, but really everything, but especially if you want to be a buyer, if you do not understand fundamentally that the easiest way to fail in real estate is to not have a real strategy, because you will get overwhelmed and lost and you will never make real progress. So it is so important that you choose a real estate investment path that is in alignment with your goals and where you're at currently and what makes the most sense to bridge the two. Like I said, for me, it's all about the numbers, the accessibility, the scalability, and the returns, because that means faster freedom and that means higher returns per investment. I think everyone should think that way, but maybe I'm just too much of a numbers guy, and that's why I operate this way, and it's been to my advantage, and maybe it will be for you too. And the biggest way to do that is to clearly define your 4 pillars of your investment strategy. How are you going to acquire deals? Where are they going to come from? How are you going to finance them? How are you going to fund them? In your management strategy. If you just choose this, whatever it is, even if it's not the perfect one, if it's not mine or whatever, and they're in alignment with each other, we didn't talk about that. Like, they have to be in alignment with each other. Like I said, you're not going to buy property cash typically as a rental. That doesn't really in alignment. You're putting too much money in. That's why we went over the numbers a little bit. If you choose an investment strategy that is in alignment and you go all in on that, you're like ahead of 90% plus of other investors, because you are actually doing things intentionally and you're flooding all your time, energy, and resources into this instead of a little bit here and all the variations there, all the variations there, all the variations there, all the skills and knowledge and whatever crap you have to develop. It is so much better for you to choose an investment strategy that's in alignment with you and your goals, that's in alignment with each other, and execute on that than anything else. I gave you exactly what has worked massively for me and so many other investors. our super investor investment strategy. And that's what this was. So I appreciate you guys. Have a great rest of your week, and I will see you the next time. If you want the cheat code and the cheat sheets and all this other stuff that'll come with this, show some love in the video. I need to see some love on these videos. A lot of people are watching. I feel like we're not getting the love that we need. Can you drop a comment if you got some value and help other people? Can you share it with other people? If you got value, can you like it? I dedicated over an hour of my time live plus hours before to prepare this for you guys. Can you show me a little bit of love in return so I continue doing this stuff for you guys? Really appreciate that. And in the free Real Estate Freedom Roadmap community, that's where I'll drop some of the resources. I'm going to drop that link one more time. I'm going to show it across the screen. Go there. It's free. There's all those trainings, tools, resources, all that other good stuff. Take advantage of it. The only things I charge for are my highest level super investors mastermind community to create a massive filter, because you need to be ready for that so I can help you grow and scale. It's not for brand new investors, those who are looking to grow and scale their existing portfolio or what they're currently doing and get to massive levels through really going all in on those 3 C's and the core pillars of that. The co-living community, once again, another mini filter, but I literally dominate the entire landscape and providing you way more value at a way lower cost and giving you the option to try it month by month. And if you don't think it's valuable, get out. Get out, take all the resources, learn what you need to, and get out if it's not valuable for you. If it is, awesome. And everything else, for the 90% of you guys, I tried to give away for free. I try to give away all the things I wish I knew and learned, because I really care about impacting you guys on your investing journey, regardless of where you're starting out. So please show me some love, share with others. Please do all that. I greatly appreciate it. And if you're ready to get the co-living education, the step-by-step, awesome. Join that if you're ready for it. No pressure from me. If you think you're in a position in which super investors might make sense for you, do the short application. It might or might not filter you out. I know some of you guys apply and it says, hey, you know what? Maybe use the free resources, or hey, co-living education might be better for where you're currently at. It's because I'm not here to just get everyone to join every single paid thing for the sake of it, right? It's literally if it makes sense for you and where you're at. I think the co-living makes sense for everyone, but that's where I'm going to do my free 3-day co-living challenge. It's coming up, and I'll give you a great taste of co-living, and you can decide if you want to take your education to the next level. If not, keep enjoying the free YouTube content, the free school community, all that good stuff, and help each other out on your investing journeys.